Chris, good to see you. A really important topic today. 3 strategies to minimize your Social Security taxes. Many retirees are surprised to learn that above a certain income, Social Security is taxed. And in retirement, it's important to know how all your income streams will be taxed and how to mitigate those taxes. But let's start with the basics. How are Social Security taxes calculated?
Well, it's an income question there, Aaron. And the more income you have, the more of your Social Security benefit that will be taxable. And the most common one is, a married couple, $32,000 to $44,000. They're going to pay tax on up to 50% of their Social Security income. Above that threshold, then they can pay income tax on up to 85% of their Social Security benefit. And the problem here is none of these numbers have been adjusted for inflation. So more and more Social Security benefits for the baby boom generation are in fact being taxed.
Right, good point. And we can see according to this table that it's all based on your provisional income. So can you explain what makes up your provisional income?
Sure can. It's a little different formula than, your typical 1040 that you're filing with the Internal Revenue Service. The provisional income to determine whether or not you pay tax on your Social Security benefit only includes half of your Social Security benefit itself. So that's a nice break there, but it does include required minimum distributions or any distributions from a taxable IRA, 401k, CD interest, even municipal bond interest that's
Wow.
income tax free can be included in this total. Rent, dividends, all of, your basic income structure, but only half of your Social Security benefit. That's where you get a little bit of a break.
I can see where that would add up quickly, though. So let's talk through 3 strategies then to reduce your taxable income. And the first strategy would be to convert your tax deferred accounts to Roth accounts because, Chris, as we've talked about many times before, they are often your greatest liability.
Yeah, they certainly are. When you take money out of a traditional IRA or a 401k, you're paying income tax on all of those distributions. If you convert them into a Roth IRA over the course of time, then you have tax-free distributions. That doesn't drive up your Social Security taxation, nor does it affect your Medicare premiums either. So you kind of get a win-win on that one.
Mm-hmm. And the second strategy, you say, consider shifting your income investments because some investments generate taxable income, others are non-taxable.
Yeah, that's correct. And, if you had money just sitting in a savings account, not earning much money, you almost paying yourself out of your principal. That's one way people get around it. If you have a life insurance policy that has cash value in it, then you can certainly take a properly structured loan out of that and not create any additional taxation. But it's really hard, with regular investments, CDs that people are investing in now, money market accounts, those are generating interest and that's taxable. So it is a difficult one to do.
Mm-hmm. And then this third strategy, I know seems straightforward, but I know it's complicated. Delay claiming your Social Security benefits.
Yeah. And as people live longer, and if we're dealing with especially a husband and wife combination, because we want to help maximize Social Security benefits, and you can delay taking them all the way up until age 70, you get the biggest benefit. You would leave the biggest survivor benefit for your spouse, should you predecease them. And it is a great way to do some income planning. It also gives you the ability to do a little more tax planning if you're not relying on Social Security for income by delaying.
Mm-hmm. What I'm hearing through all these strategies, Chris, is that proactive planning is key. So if somebody wants to talk to you about implementing some of these strategies today, what's the best way to reach you?
The best way to do is set up an appointment with us and call Heidi at the office at 866-695-2620. We have an office in Port Clinton, Fremont, and also in Perrysburg. So, we're very flexible to meet with folks and begin the conversation, if nothing else.
So important. Chris, thank you so much.
My pleasure, and thank you.
Tune into Chris McIntyre's full radio program and visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntyre. Be sure to subscribe.